You know we gotta do it to you. You know we gotta do it to you. We gotta hit you with that big fat freaking smolder boulder, baby. Oh yeah, that's how we do it. That's how we do it. Holy Toledo. Woo! What is up, everybody? Welcome to Trades. We freaking talk fast and don't skip class, baby. Like popular saying that I'm not a financial advisor or expert. So take what I say with a grain of salt. Let's get into the video. So today, my friends, my fellow gorilla gang, I want to talk about the Wells Fargo situation. This line of credit removal, closing all personal lines of credit that is happening with Wells Fargo, because this is a story that I don't think makes a whole lot of sense, right? The kind of picture that they're painting right now doesn't add up in terms of what their balance sheets say, what the overall economy says, what the Federal Reserve is saying, and what money's saying, because money talks, my friends, and this is a bunch of baloney. It doesn't make any sense at all. So we're going to go through a couple different topics here. I'm going to start you off with a preface, talking about the reverse repurchase agreement market, right, just to give you an idea of what this actually is. I want to talk about margin debt. I want to talk about what a line of credit really is. I want to talk about money being printed and how this can actually relate to the overall Wells Fargo situation. Part of this is fact, right? A lot of this stuff that I'm going to go over with you is just hard fact. This is stuff that has been coming out, right? It's just things that are known about this certain situation. Then I'm going to give you some opinions, some speculation. I'm going to let you know when both those situations are happening. I'm going to try and connect some dots for you, but just know that there is some speculation involved in this overall piece. So without further ado, baby, let's get into this video. So I want to start off here by talking to you about, in case you didn't catch it, the Wells Fargo debacle in terms of lines of credit. They came out a couple days ago and they publicly stated that they're going to be shutting down all existing personal lines of credit and that they are not offering the consumer lending product anymore. The product, which usually gave users $3,000 to $100,000 in revolving credit lines, was pitched as a way to consolidate higher interest credit card debt, pay for home renovations, or avoid overdraft fees on linked checking accounts. Customers have been given a 60-day notice that their accounts will be shuttered. According to the report, Wells Fargo did not respond to any sort of questions that were asked. Now, the thing that I find the most peculiar is this $3,000 to $100,000 credit line revolving, right? Because this is actually a pretty small amount of money in terms of a lot of the different customers who might be asking for margin or loan or some sort of credit line from Wells Fargo. They're pitching essentially saying that, hey, look, we're going to shut down this $3,000, $100,000 credit line so that we can consolidate interest rate or credit card debt, so we can work on some loans, so we can just take care of a whole bunch of different things. But what doesn't really add up to me is this $3,000, $100,000 in credit lines would be about the same as credit card debt and or home renovations and or personal loans. Because think about the amount of money this is, right? These are the little guys. These are individual people who are taking out credit lines, and that's essentially saying like this: look, I'm going to take away my $5,000 that I've got pitched towards this company. I'm going to put into $5,000 of the other company. Both companies do the exact same thing. It doesn't make sense, right? The money is still about the same in both scenarios. So why would they want to do this? So just asking these personal questions, it doesn't seem to make a lot of sense. And as I always say, if it doesn't make sense, it's probably because it doesn't make sense. So if you don't know what a line of credit is, this is probably the most important thing to start with. It's kind of a financing that is extended to individual, corporation, or government entity by bank or financial institution. The big thing here is this: individual, corporation, or government entity. Now, the people that this affects is the little guy. You've got corporations, you've got government entity, which could be the Federal Reserve, the feds, right? That's not affecting them. It's not affecting the corporation or the government entity. These are little guys. Remember, $3,000 to $100,000 revolving credit lines was pitched as a way to consolidate higher interest credit card debt, pay for home renovations, or avoid overdraft fees on linked checking accounts. That's what they're wiping away. The reasoning for this is goofy. It's because they want to take care of different, credit card debt. They want to take care of different loans. But it's about the same sort of ballpark money. The only logical explanation that I have is that there's so many people here using credit lines that it outweighs the money that's going towards this, the credit card debt and or these loans that people are taking through Wells Fargo. It's possible, right? That's a possible explanation, but it still does not make a whole lot of sense. I'm going to tell you why here in a little bit. So before we get into what happened with Wells Fargo, I want to talk about the reverse repurchase agreement market, margin debt, and money that's been printed, because I think it's going to paint the picture in terms of what's actually happening here with banks. Banks have more money than they've basically ever had. I mean, you look at the overnight reverse repurchase agreement market, this kind of gives you an idea of how much money these banks have. An RRP, or reverse repurchase agreement, essentially is the act of banks having so much money that they have to give some to the Federal Reserve. This is a transaction, right? So in this transaction, the feds are giving away treasury bills to banks. They're selling these treasury bills, banks are giving them money in exchange for these treasury bills, and the feds hold on to that money overnight. They just recently hit almost $1 trillion in reverse repurchase agreement back here in the last couple of days. That's an exponential amount of money, which is just giving you confirmation factual confirmation that banks have on paper a lot of cash. But there's a problem with this, right? The problem with this reverse repurchase agreement that makes it look like banks are doing so freaking well is you're not getting the whole picture. You're not looking at margin debt, and you're not looking at money that has been printed. So we're going to start off here with margin debt. You look at the FINRA margin debt report as of May 31st, 2021, and it's near all-time highs. Let's look at the maximum here. Let me do that. 5 years, whatever. So you got $861 billion of margin debt. This is essentially leveraging that goes into the stock market. This can come from a variety of different people, whether it be institutions, whether it be just regular individual retail investors, whether it be banks that are lending out money to institutions that are then going into the stock market. There's a lot of different ways that can work out. But essentially what this is saying is there's a lot of money being thrown into the U.S. economy that's leveraged. It's all-time high leveraging that's coming from maybe the Federal Reserve, maybe banks, more likely banks since banks are holding on to so much cash, right? But this paints you the picture. There's a lot of debt that's getting thrown around, and it's just continuously going higher and higher and higher and higher. You can essentially think of this like, okay, I know that I've got $100,000. This is my yearly income's 50 grand. I've got a $100,000 mortgage. And you know what I decided to do instead of paying off my mortgage that, is maybe, improving in value. It's accruing some sort of intrinsic value through the U.S., housing market. Instead, I just go out and buy another $100,000 house, even though I'm making a $50,000 a year salary. I know that it's not sustainable, but I just keep doing it. I keep doing it. I keep throwing 100 grand here, 100 grand here, 100 grand here, 100 grand here. And that's what's been happening for the last 1 year on a much larger scale with a lot of these big banks, institutions, and buyers that are throwing money in the U.S. economy. Last thing I want to talk about is this before we get into the meat and potatoes, and that's how much money was printed in 2020. More than 35% of U.S. dollars ever printed were made in 2020. Now, this is an important thing because, as I just mentioned, you've got all-time highs in terms of reverse repurchase agreements. The banks have more money than they've basically ever had. Almost $1 trillion was hit in an overnight reverse repurchase agreement in the last 1 or 2 weeks. But what you don't see is that this is actually inflationary. How much of that money is actual gains? How much are they actually improving their overall balance sheets? And how much of it is just inflation? Because what you've seen, and I think in the U.S. stock market overall, is basically inflated gains. It looks like the market's on an absolute rampage, but how much of that is real, right? If you average 3 to 5% an annual, year over year return on income in the stock market, but 35% of the money ever printed came in the last year or so, how much of that's real, right? Obviously, some of those gains are going to be wiped out by the inflation that's going to come and follow through with that much money being printed. Now, this is all important stuff because essentially what it is saying is true. Banks have more money than they've ever had, but we also know this. A lot of money has been printed, which means a lot of their gains are inflationary. And secondly, margin debt is at an all-time high, meaning that banks likely are also playing pretty heavy in margin, in debt, in their total assets versus liabilities. And this is where things get fascinating because when you look at Wells Fargo and their overall assets versus liabilities, their cash on hand, all the facts that would make it look like, hey, look, we got to wipe out this line of credit thing for our customers, essentially to take care of other liabilities that we have on our balance sheets, it doesn't make a whole lot of sense, right? So what happened? Well, we didn't know that Wells Fargo wiped out lines of credit. There's 60 days for a lot of these members to essentially clean up their lines of credit, which, by the way, sucks. It's going to affect their overall credit scores. Some of these guys might default on their credit lines. Who knows if they can even pay him off, right? The little guy got fucked on this one. It's garbage. Absolute garbage. So what made me start to ask some questions is banks are flush with cash, right? We've seen this. We've seen that banks have more money than they basically ever had. It's honestly freaking mind-blowing how much money they have. But what doesn't add up is the Wells Fargo balance sheet. So I started to think to myself, okay, if they're taking away this line of credit, it must mean that their actual liabilities are pretty out of hand. It must be pretty rough, right? If they have to take from essentially one line of credit, one sort of way that they're accruing interest and making money and pay off other things, how are their assets versus liabilities? Their assets in 2020 were $1.9 trillion. These are in millions, right? So that's 1.9 times 1 million, which is 1.9 trillion. The total liabilities, 1.779 trillion. So they actually have a net difference of about $200 billion in extra cash. Their assets are greater than their liabilities. Well, hold on a second, right? If they're saying that they need to take care of this line of credit so they can pay off credit card debt so they can take care of other loans that individual members have, right? Well, that must mean that their assets versus liabilities must be a little jacked up, but it's not. It's not, right? Which makes me kind of wonder a little more. So I go deeper into the depths here. You're looking at the overall total liabilities, long-term debt, cash on hand, total assets, and you look at these, based on different time frames. Here's as of March 31st, 2021. They've got $1.9 billion in total. What the? I don't want that sound. They've got $1.9 billion in terms of overall cash on total assets, as I was. Cash on hand, they have a lot of money too, $439 billion. Now, you combine those together, you've got a pretty decent chunk of cash. $1.95 billion. That's in the trillions. That's a lot of freaking cash. You look at their long-term debt, doesn't make sense. $183 billion. Let's look at their total liabilities. Total liabilities, $1.77 billion. Now you add all this up together, right, and you still have more net difference positive cash than you do negative. So where is this all making sense, right? Where does this come into effect? What does this mean? If the total assets versus liabilities is green, it means they've got more cash than they have debt. Well, how come that is the case? How does this make any sort of sense? My answer to you is it does not. There's not a lot of transparency that's taking place here with this Wells Fargo debacle. And this affects the little guy, man. This affects the little guy exponentially. So the only explanation that I can come up with that makes any sort of sense is these banks have so much cash that is inflated, that's based off of heavy leveraging that came from the U.S. economy, the Federal Reserve printing massive amounts of hemorrhaging money, man. I mean, this is going to really affect the U.S. economy in some sort of way in the next 1, 2, 3 years. Who knows how much? But the only thing that I can think of is a lot of this cash is inflated. It doesn't actually, it does exist, but it's not being fully, the picture's not painted, right? You're not seeing what's actually happening here because of how much money's been printed, how much overall debt there is in the U.S. economy, and how much of this money's getting moved around on a day-to-day basis. I think there's something really interesting to show you right here. Check this out. A $9 trillion binge turned central banks into the market's biggest whales. Now check this out. Since the start of the pandemic, central banks in the US, Europe, and Japan have been on a $9 trillion spending spree. This just confirms the fact that banks are flush with cash. They've got a crap ton of money. That binge has turned the U.S. Federal Reserve, the European Central Bank, and the Bank of Japan into ultimate market whales, swelling their combined assets to $24 trillion. That's nearly half of the U.S. stock market's liquidity that is basically allocated to all stocks across the market. It would take all of these companies right here, all their market caps, to make $24 trillion, right? Now, why is this important? If the banks have so much money that they're just basically giving away free cash to the Federal Reserve every single day, nearly $1 trillion day in terms of reverse repurchase agreements, overnight RRPs, right? What does this mean? The only conclusion that I can come to with this Wells Fargo sort of situation is there's a lack of transparency. This is sketchy stuff. This does not make a whole lot of sense. You're trading apples for apples. You're affecting the little guy, his line of credit, for basically no direct reason. They're not really stating anything that gives me any sort of validation towards the fact that they should be doing that, right? Their balance sheets look good on paper. Who knows how much of that's actual debt? Who knows if they're even actually painting the picture? We know that Wells Fargo in the past has committed to fraudulence by creating bank accounts that weren't even supposed to exist, right? Who knows if it's happening again? I'll tell you that right now. This is a big freaking red flag. I do not like this in the least bit. And I'm going to tell you why. This is going to tighten down the economy. If banks have so much freaking money right now, one day you're going to wake up and the feds are just going to take this money back. It's not going to be an overnight reverse repurchase agreement anymore. It's just going to be an RRP. It's going to be a reverse repurchase agreement, meaning that the feds just want their freaking money back. And they're going to say, hey, banks, hold on to these freaking treasury bills. We're going to park your cash right here in the Federal Reserve. You don't need this much money anymore. What happens when banks have this much money? My conclusion that I'm drawing, this is opinion, this is speculation, is that banks like Wells Fargo are all of a sudden pulling lines of credit, but they're not really doing anything with the big boys, the institutions, the corporations, the Federal Reserve, because they're still continuing business as usual, as normal with these guys. This is a sign that there's going to be a tightening down on the economy. It's going to raise interest rates. You're going to see inflation go up. You're going to see less overall liquidity that's given to the general public, the little guy. That's going to affect the U.S. stock market. How's it going to do that, right? Think about it like this. It's a tightening effect. You're tightening down the economy, which is going to cause a slow market, either this sort of stuff, the up and down, the consolidation, or a bear market. And the reason that I believe that is if you think about this very simply put, right? Oopsie. If you think about this very simply put, if there's X amount of allocated cash at any sort of given time, right, and you decrease X by why? All of a sudden you take out, let's just hypothetically say $100 billion, but you used to be playing with $200 billion. Well, there's less overall supply, which increases demand. It's going to raise the interest rates. If there's more demand for money, it's going to raise interest rates. It's going to mean that there's more inflation. If there's less overall liquidity available to the general public, it just creates bad things for the U.S. economy. So does this affect any individual stock in the market? That's speculation. I'm not going to sit here and pretend like I know that it's going to affect, shorted stocks. I'm not going to pretend I know it affects X, Y, Z, but it will affect the U.S. stock market. I really do think the economy and the stock market, this is a big red flag. Wells Fargo, when you think of one of the biggest banks in America, that's one of the biggest banks in America, man. Who knows how many others are going to start following suit with Wells Fargo, This is sketchy stuff. It doesn't make sense. Assets versus liabilities, they've got way more cash on hand than they do liabilities. They're sitting absolutely fine in terms of the balance sheets on paper. Who knows if it's legit, right? I can't tell you that for sure. But this ain't it, Bob. This ain't it, Bob. I'm telling you right now. This should make you ask some questions. I'll be watching very closely what comes out with Wells Fargo here in the future, because the reverse repurchase agreement market says, hey, banks are flush with cash, no reason for this. They're continuing business as usual with corporations, with the Federal Reserve. Only the little guys getting fucked here. That should make you really ask some questions, and that's what I've got for this video. So blah, 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 I know spiel, drop it like a subscribe with you, my friends. Catch you on the next one. Light taps, light taps all day, every day. Much love, and peace.